Welcome to the October 8th, 2017 Advance Report for McGowanGroup Asset Management clients. A quick graphic briefing, and now that the third quarter is financial history, here are the results. An amazing rally in the Dow, 13.6% year to date. Put the dividends on top, that's about a 15% total return. The NASDAQ, thanks to technology and a biotech comeback, about 21%. The European Stock Exchange, up overall 22% year to date, and they said percentage year to date and then US dollar year to date. Notice the difference. The FTSE 100, that's the Great Britain exchange, 12% in US dollar terms. Germany about a 25% rally. Truly an incredible global story. And notice the reward that international investors are enjoying here with the Hang Seng Hong Kong Index, 24%. That's truly amazing. The emerging market rally is becoming one of the biggest stories of the year, with about somewhere between 25 and 30%, depending on how the particular emerging market index is weighted. Commodities, big comeback here for a lot of the commodities, for most of the metals. 35% palladium, 24% aluminum. Copper is really your global benchmark. If we were in a global recession, highly unlikely that copper would be up 17%, gold up an 11%, and spot silver rebounding by about 5%. Notice West Texas Intermediate crude oil still down for the year, about a minus 6%, despite the recent rally. Gasoline also down a commensurate 6%. And when we look at the impact of the commodity bear cycle, natural gas a minus 22 so far this year. When we look at those numbers, we're seeing the shale revolution and the impact, but it also has deep implications. It is highly unlikely that we're going to see big inflation numbers in the short term with that. Now, construction costs obviously rising, shortages of sheetrock and building materials, that's going to be a factor. So let's take a look at interest rates. Here, the Federal Reserve balance sheet, they racked up $4.5 trillion to go buy bonds and mortgages and push the rates back, or push the rates down to get the economy going again. Did they overdo it? Well, this is their forecast reduction. They started at about $1 trillion, quantitative easing $2 trillion, then all the way up to $4.5. And here the contentions were would have big inflation, didn't actually materialize, and they'll start to dial that back. They just let these bonds come due and the antimatter off the balance sheet. Central bank policies, just a quick tour here. The Fed funds rate having been raised above 1%, forecast to go as high as 3%. If inflation stays at 2%, the Fed's got its hands tied because the long rates have actually come down. Join us for the long play program, NetWorthRadio.com. Alex Tilleen will join me this weekend, and you'll get all the details at NetWorthRadio.com, including more research than what you see here. Thank you for joining us.